Okay, so we also discussed how to compute the cost of preference share. I mentioned that we have fixed, we have a redeemable as well as the irredeemable preference share. And I said that the cost of irredeemable preference share represents the ratio of fixed dividend to ex-div share price. Of course, we solve a short example to demonstrate the point. And thereafter, we move to discussing the cost of redeemable preference share. And I said that the cost of redeemable preference share is simply the same thing as internal rate of return. That whenever you are asked to compute cost of redeemable preference share, just go ahead and compute internal rate of return by assuming two discount rates that will produce two opposing NPV. All right. Then you now proceed to you interpolate whatever the result you've gotten from your positive and negative NPV, you put it in the internal rate of return formula. Whatever you have will represent cost of redeemable preference share. It's as simple as that. Then, of course, that's where we stopped last week. Then today we are going to commence the cost of debt. After cost of debt, we talk about cost of convertible. So if you still have time, then we now move to discussing the weighted average cost of capital. So let's talk about cost of debt briefly. Uh, okay, you all have the material. Please switch to your open to your material. Let's talk about cost of debt. Let me use my working notes just to. Okay, should I even use this material instead of the working note? That will be faster. Okay, let's see. Let's see. Cost of. You can just ask your colleague from the WhatsApp group to share the material with you, Ogechi. Somebody from the group will share with you. All right. Okay. Let me just explain. Let me use, let me use, open to the material. Let me talk through let me use working note to share, to discuss this. Okay. Let me know if you can see my screen, please.
Can see.
Yes, sir.
Thank you.
Yeah, we can see you, sir.
All right, thank you. Please kindly mute everyone. If you want to ask me a question, just raise your hand. All right, then. So let's talk about cost of debt. Just like we have done for cost of equity as well as the cost of preference share. You will recall how we started under cost of capital. I said that cost of capital represents the compensation required by the providers of capital from their investment in a company. Then we now said that when you want to calculate traditional WACC, that there are four procedures you are supposed to carry out, isn't it? The first step is to calculate cost of equity. Then step two, you calculate cost of preference share if you have it in the capital structure. Then step three, you calculate cost of debt. So that's step three you want to talk about how you are going to do it. That's what we want to discuss today. All right, how to calculate cost of debt. But first thing first, before we talk about how to calculate cost of debt, what is debt? All right, what are the types of debt? All right, so how do you calculate cost of debt? So let's quickly go into that. All right, so when you talk about debt, first thing for cost of debt represent the compensation required by the providers of debt capital. I repeat, cost of debt represents the compensation required by the providers of debt capital. Okay, when a company borrows, the loan that the company borrow will be, I mean, there's interest attached to that loan because the loan is not for free. So the loan, I mean, the interest attached to the loan is the cost of debt, is the cost of finance. So when a company liquidates, all right, when a company liquidates, the debt holders, all right, will be settled before the preference shareholders as well as the ordinary shareholders. So in the event of liquidation, the debt holders will be the first creditors to be settled. All right. So the cost of debt, when you talk about debt, debt has tax deductibility benefits. Okay, debt has tax deductibility benefits. That is, when you talk about debt is cheaper, we call it a cheaper source of financing because of that tax relief, because of the tax benefit associated with financing with debt. And that's why it is cheaper. So uh, basically, there are two types of debt. All right, we have traded debt. We also have non-traded debt. Let me see. You may have to give me 1 minute. My pen, because I did not connect, it's not connecting to the screen. Let me quickly, just give me 1 minute, please. Let me go out and come back again.
Please, what
Thank
page
you
are
for
we
holding.
seeing?
Thank you for holding on. So,
Page
like I was saying,
39.
there are two types of debt. Types of debt. Basically, there are two types of debt. One is traded debt. Okay, traded debt. Then two, non-traded. Non-traded debt. Let's talk about each of them. Okay, the first one is traded debt. What do you mean by traded debt? These are fixed income securities. Okay, let me put it down. These are fixed income security that may be bought, that are bought or sold, or that can be bought. Let's put it that way. That can be bought or sold in an organized financial market. Okay? So when you talk about traded debts, they are kind of fixed income securities that are tradable. All right? You can buy it, you can as well sell it in an organized financial market. It is called fixed income securities because the benefits associated with these securities are fixed in nature. For example, when you talk about, okay, let me just put it. Examples include Examples include bond, debenture, or loan notes. So these are examples of fixed income securities. All right. So you can, for example, when you look at bond, all right, the bondholder is entitled to fixed interest from the investment or from the company. All right. So when the company needs money, they can approach investor for loan. All right. The company is going to issue bond to those providers of capital, to the lender or to the investors, that, okay, I'm going to pay you back maybe in the next 5 years. That 5 years is the maturity date. All right. The maturity date is the date that the company will redeem the bond from the investor. All right. It is the company that will issue the bond. The people that have the investor that have borrowed the company's money, they are the bond holder. They are the one that will hold on to the bond. The bond is just like a certificate. All right. So when you talk about fixed income securities, so there are those security, there are fixed income security, or there are those kind of security that can be tradable in an organized financial market. For example, this bond now you can sell it. Okay, you can as well buy it. So these are examples of traded debt. So in most cases, when you talk about a company's capital structure, it is the bond. You can see bond, debenture, or loan note. These are the ones you are going to see in the capital structure of a company because it's a source of long-term financing. All right. Then let's talk about non-traded debt. The non-traded debt is just the opposite of the traded debt. Okay. Non-traded debt, these are securities. These are securities that are not tradable, or that cannot be bought or sold in an organized financial market. Okay? So when you talk about non-traded debts, it can be bought or sold. It's not tradable. You can't buy it. You can as well not sell it in an organized financial market. Who can tell me one example of non-traded debt if you have idea? Raise your hand if you have idea of non-traded debt. Give me one example. It's very common. It's something every one of you are familiar with. Yes?
Commercial papers.
No.
I think
Yes?
loan or overdrafts.
You know, when you talk about commercial paper, you can sell it. You can trade with it. Yes, somebody mentioned something now.
Is it stock?
I said
Yes?
loan or overdrafts.
Stock.
Hey,
Credit
you started
certificates.
though. This is not market. This is not market.
Credit
I say if you
certificate.
want to talk, always raise your hand. Let's be up. Moses, talk to me.
All right, sir. I like. Is it stock?
No? Yeah, somebody mentioned it. Somebody mentioned one of it just now. Yes,
Credit
Victor
certificate.
Omorobe. We are going to quarrel. I've not called you.
What of
Your hands. Omorobe,
I
talk to
said
me.
bonds or certificate of
Pardon?
deposits. Bonds or certificate
It
of
can't be bond
deposits.
now. You are wrong. That's not
How
correct.
about
Yes,
certificate of
Femi,
deposits?
you raise hand.
what of private loan?
Femi,
Private loan.
no, no. Private loan, yeah, is very close. Private loan is close. Yes, Naomi.
Bank overdraft.
Bank overdraft. You are correct. Bank overdraft. You can see, you cannot take your bank overdraft to the market and sell it. Is it possible? Can you sell off your bank overdraft? That's not possible. You can as well, you can't buy the bank overdraft, right? Yes, one more. Victor Omorobe. Yes,
How about normal time loans offered by banks, normal time deposits?
bank loan, right?
Yes, normal time loans.
Yeah, so bank loan is also an example. So let me just give it to you. Yeah, those are the two. Your bank loan, when you go to your bank and borrow money, all right, you cannot take that loan that you have borrowed to the bank and to the market to say you want to sell it, right? That's not possible. All right. So you can as well, you can't go to the market and buy the loan. So they are not tradable. All right. So examples. Thank you for
Promissory.
participating. Examples include bank loan
Promissory note.
and overdraft. Okay. Overdraft. So these are the two key examples of traded and non-traded debt. All right. So that's that. Now let's talk about, we have talked about types of debts. Then let's talk about, like I was trying to tell you the other time, that debt is a cheaper source of financing because of tax deductibility benefits. When a company finance its operation with debt capital, the company is expected to claim tax relief, okay, tax relief on the debt. As a result of tax, the cost that the company will pay on the debt will be lower, and that's why we said debt is a cheaper source of financing. Now, debt could be redeemable or irredeemable, callable or non-callable. So let's talk about the redeemable and then callable debts. They are close, just a little different between the two. All right, but let's talk about each of them so that we can quickly move to the next one. Let's talk about irredeemable debt first. Okay, cost of irredeemable debt. Okay, cost of irredeemable debt. So now you can see whenever I'm talking about debt, you should know which of them. Is it traded debt or non-traded debt? So whatever we are going to be doing, especially when it comes to redeemable, so we'll be referring to those traded debts. When you talk about irredeemable, all right, usually those non-traded debts are kind of irredeemable debts, all right? But let's move on. Now, let's talk about irredeemable debt. The irredeemable debt, let me put it down. Irredeemable, let me write it. Irredeemable debt is the one in which the company will pay annual fixed interest I didn't notice that my network has disappeared. Please, can you remind me where okay, let me just recap. I said that the cost of irredeemable debt represents, is the irredeemable debt is the one in which the company is expected to pay annual fixed interest, but the principal will not be repaid. Okay, the principal will not be repaid. So the cost of irredeemable debt, the cost of irredeemable debts represents the ratio, all right, represent the ratio of fixed interests to X int price to X interest price. Okay, it can be calculated using the formula below. Okay, so whenever you want to calculate cost of irredeemable debt, just divide the fixed interest with the X int price. Okay, it can be calculated using the formula below, depending on whether or not, depending on whether or not there is tax. Okay, so let's talk about each of them. Number A, where there is no tax. Where there is no tax. All right, how do you calculate cost of irredeemable debt where there is no tax? Okay, so cost of irredeemable debt, denoted as KD, will be computed as the ratio of fixed interest The interest is also known as coupon payment. All right, examiner can call it coupon payment or interest. Okay, divided by X int price. You will recall when we had cost of equity. Under cost of equity, the denominator is called XDIV share price. So under debts, it is called X int price. X interest price multiplied by 100 over 1. So this is the formula for calculating cost of irredeemable debt. This is the formula for calculating cost of irredeemable debt, all right, where there is no tax. So you go to the question, you go and pick the you go and pick the coupon payment, okay, for the debt. The interest rate is the coupon rate, all right? So you pick it. So you divide it by the X int price. This X int price is the market value of the debt. Okay, is the market value of the debt per unit. Okay, so that is for that. Then number B, where there is tax. Where there is tax. So under this circumstance, how do you calculate cost of debt? Where there is tax, cost of irredeemable debt will be computed as fixed interest multiplied by 1 minus tax. Okay? Multiplied by 1 minus tax divided by X int price. Let me rewrite that. X interest price multiplied by 100 over 1. So that's just the difference between the two. When you go to the question, if you can see, if you are given the company tax rates and you are asked to compute cost of debt, all right, of course, you are expected to adjust for tax. That's why I mentioned to you when I was giving you the definition of debt. I said debt has tax deductibility benefits. So once you are given tax rates in a question, that means you have to adjust for tax because you are expected to use post-tax or after-tax interest to compute your cost of debt. All right. So this is how to calculate cost of debt. If there is no tax, you use this formula. But when you are given tax rates, this is the formula you are expected to use to calculate your cost of irredeemable debt. Okay. Now, notes. Notes. Okay. When cum int price is given, when cum int price is given, it means when comment, okay, let me just put it. When comment price is given, it should be converted to X int price. Before calculating cost of debt before calculating cost of debt. Okay. So the same way you adjusted for dividend when we calculated cost of equity, you also need to adjust for interest when you are calculating cost of debt. All right, because you are expected to use X int price. Whenever you want to calculate cost of debt, you are supposed to use X int price. But if the market price of the debt is cum int, if you are given a cum int price, so you need to convert it to X int price. Therefore, X int price is calculated as cum int price minus the fixed interest. Okay, so this will give you the X int price. All right. So remember, when you are calculating cost of debt, you have to use the X int price. So if cum int price is given to you, it must be converted to X int price. All right, because the cum int price given to you included the interest expense. The interest must have been paid before you calculate the cost of debt. So if interest has not been paid, then it means that the market price of the debt given to you is cum int price. So you need to convert it to X int price. All right. So this is what you need to know as far as the cost of debt is concerned. This is irredeemable debt. Now, of course, there is nothing like growth. When you are calculating cost of debt, there is nothing like growth. And that's why you can see it's fixed interest. All right. So the interest is fixed in nature. So nothing like growth. All right. So that is basically that. At this point, let's have a short example before we move to cost of redeemable debt. Now, okay, maybe when we get to redeemable debt, I will tell you those ones. Now, one thing you need to also understand is that debt is usually quoted at 100 naira per unit. Let me use this one as one. Then number two that you need to note. Debt is usually quoted at 100 naira per unit. Okay. Except examiner says otherwise. At times examiner can give you the value to be 1,000 naira per unit, but in most cases it will be 100 naira and it will be implied in the question. All right, so I say it's usually quoted at 100 naira per unit, except the examiner says otherwise. All right, so you should watch out. It is always at 100 naira per unit of the debt. So that's why whenever you are given interest rates, you don't need to divide it by 100. Just use the interest. Say, for example, you are given interest rate of 5% and you are asked to calculate cost of debt. Just use 5 instead of say 5 over 100, which is 0.05. Just use 5 because you are still going to multiply with 100 units. Sorry, with 100 naira per unit. So always ignore the percentage when you are calculating for debt. Okay, then. Now, let's have short examples. Let me stop sharing. We'll come back to this later on. Let's go to short examples. Okay. Let's see. Debt. Okay. This is preference share. Yes. Let's solve this illustration number 6 to practice what we have just discussed. All right. Illustration number 6. Who will help us to read?
Page what, sir?
Yes,
Page
who is that?
what, sir? Page what?
Is on page 45.
45.
Yeah. So he's helping us to read illustration number 6. Okay. Let me look for partner. Yeah. Yes, Moses, you want to try? Okay, Ogechi, go ahead.
Should I read?
Yeah, Ogechi, you want to read? Is that why you raised hand?
Yeah, let me go on.
Okay, Femi. Okay, go ahead. Thank you, Moses. Yes, Ogechi, go ahead.
Page 45, illustration 6. Cost of irredeemable debenture. Redeem PLC is financed with 10 million naira, 9% redeemable debenture, quoted at 102 naira. Interest on debenture was paid last week. What is the cost of debenture if 1. The company is not liable to pay tax? 2. The company tax rate is 40%.
All right, thank you very much, Ogechi. Yes, you can see in this question, examiner told you that the company has 10 million 9% redeemable debenture. Examiner has called it redeemable debenture. Debt will only be redeemable if the redemption date is given to you. You know, I mentioned it when we had cost of redeemable preference share. All right, it's the same thing as under debt. So debt will only be redeemable if the redemption date is given. If you are not given the maturity date when the company is expected to redeem the debt, all right. So in this case, it will be called, if you are given the redemption date, that means it's a redeemable debt. But if the redemption date is not given to you in the question, you are going to treat it as cost of irredeemable debt, because you must know, you must be given the maturity date or the redemption date. You must be given in a question. But if you don't have it in a question, you will treat it as cost of irredeemable debt. Okay, that's one. Now, in this particular question, even though examiner has called it redeemable debenture, but because I'm not given the redemption date, I know that I'm going to calculate cost of irredeemable debt. Now, the quoted price is the same thing as market price, all right, of the debt of this debenture. Now, is 102 naira. This 102 naira, you are supposed to divide it by 100, because that's what I was saying the other time, that debt is always quoted at 100 naira per unit. Okay? Now, interest on the debenture was paid last week. So since interest has been paid, it means that this 102 is already X int price, because the debenture interest has been paid. So this 102 becomes X int price. Okay? So that means I'm going to use it directly like that. I don't need to do any to convert it to X int price again. It's already X int. So that's one. Now, if that is the case, examiner is now asking me to calculate cost of uh, debenture if the company is not liable to pay tax. So this is a very straightforward question. So what am I supposed to do? The company is not liable to pay tax. Therefore, I will just say, let me see if I can I will just say, okay, let me switch so that I don't need to be managing space. Okay, so that's solution to illustration number 6. Let me write this. What's wrong with you again? Okay, page 45. Aberdeen PLC. So number 1, we have to calculate cost of debenture, I would then say calculating cost of debenture. Okay, which is KD. Remember, debenture is a type of debt. Number one, is it number one or A? Requirement number one. Okay, Roman figure 1. So examiner told us that where there is no tax, okay, the company is not liable to pay tax. Where the company is not liable to tax. So if that is the case, how do you then calculate cost of debenture? So we have identified from the question that this is irredeemable debenture. Why? Because the redemption date, the maturity date is not given in the question. Therefore, you are going to, even though examiner call it redeemable debenture, but because you are not given a maturity date, then it will be treated as cost of irredeemable debenture. So where there is no tax, cost of debt is calculated as fixed interest divided by X int price multiplied by 100 over 1. So KD would then be equal to, I will go back to the question. What's the fixed interest? The interest is the coupon rate given to you or attached to the value of the debt. In this question, you are given 9% redeemable debenture. That 9% is the coupon rate. I mentioned that coupon rate is the same as interest rates. Coupon rate is the same thing as interest rate. So the interest rate is usually attached to the value of the debt. The value of the debt is 10 million naira. Okay, 9% is the interest that the debenture holders will earn on the 10 million. So 9% of 10 million will give you 900,000 naira in total. But we are using the par value. So let's move on. So the interest is 9%. So in our calculation, we are not going to do 0.09 or just put 9%. Don't do that. Like I said, debt is always quoted at 100 naira per unit. So just come here, put 9. If you do 9%, if you want to do 9%, you need to multiply with 100 units to give you 9. So always use 9. Forget about the percentage attached to the interest. Okay, so 9 then divided by the X inch price is the market price of the debenture. The market price of the debenture given to all is 102 naira. So multiply by 100 over 1. Give it to me. What do you have from your calculator? What do you have from your calculator? 9 divided by 102 multiplied by 100.
8.82.
8.82%. So that's
Yes.
approximately 9%. So the cost of irredeemable debenture for Aberdeen PLC is approximately 9%. So this is how to calculate cost of irredeemable debt where there is no tax. Then number 2, you are given tax rate of 40%. Tax rates of 40%, where the company will pay tax. Where the company will pay tax of 40%. So in this case, our formula will change slightly. Cost of irredeemable debenture will then be computed as fixed interest multiplied by 1 minus tax rates. T is the company tax rate 1 minus tax rate divided by X int price. That is the market price that excludes interest. Multiply by 100 over 1. So cost of irredeemable debenture, the interest is 9%. The interest rate given to us is 9%. I said I always forget about the percentage. Just put 9 there because you are still going to multiply that 9% by 100. So when you multiply 9% of 100, we are going to get 9. Multiply by tax rate is given to us as 40%. Therefore, 1 minus 0.40 divided by exchange price. The exchange price is 102 naira, all multiplied by 100 over 1. Okay, so KD, cost of irredeemable debenture, would then be equal to 9 multiplied by 0.60, all divided by 102 multiplied by 100 over 1. Final answer, what do you have there? 9 multiplied by 0.6 divided by 102. Yes?
8.5.
8.5. Are you sure? Do it again. 9 multiplied by 0.6.
5.4.
0.3
5.3.
approximately.
Approximately is what?
5.3.
5. You got 5.3, right? So when you approximate this, the cost of irredeemable debenture will be approximately 5%. Okay, so this is how to calculate cost of irredeemable debt where there is tax. Now, I mentioned to you earlier that debt has tax deductibility benefits. There's a tax relief associated with debt when a company finances with debt. So the company is expected to pay a cheaper, it's supposed to pay a cheaper cost or a lower cost relative to when there is no tax. So in the first example, you will see that in the first requirement, where there is no tax, the cost of irredeemable debenture was 9%. Now that there is tax, the cost has reduced to approximately 5%. And that's why we are saying that debt is a cheaper source of financing because of tax deductibility benefits. So as a result of tax benefit, the cost has reduced to 5 from 9%. All right. So that is what examiner wants to test in this particular question. Let me know if you have any question for me before I switch. All right. So let's have another illustration. Okay, let's have another illustration. Let me stop sharing. Yes, Victor, talk to me. Yes, Victor, you raised hand.
So, my question is, you mentioned that we're not using the 900,000. So you mentioned that we're using the part
900.
So
Yeah, if
yes,
you want to, yes.
10 million, 9% redeemable debenture.
Yeah.
So we're just using 9. We're not using the 9% of 10 million.
If you want to do it that way, I'm just showing you the exam method. If you want to use that way, you are still going to get the same thing. Look at, say for example, the first one where there is no tax. If I want to use, let me say, alternatively, let me write that. Okay, alternatively, if I want to use absolute value to calculate my cost of debt, I will say KD equal to 9% multiply. What's the nominal value? The nominal value of the debt is 10 million naira. So multiply by 10 million. Okay, then divided by the X int price is 102 naira. So I would then say 10 million. Remember, let me do it this way. The market value of debt is computed as, I'm going to explain this when we get to weighted average cost of capital. So when you want to calculate market value of debt, ordinarily is supposed to be nominal value, okay? Nominal value multiplied by X int price divided by 100 naira. Because debt is always quoted at 100 naira. So whenever you want to, for the market value of the debt, you have to divide it by 100. That 100 is constant. So in this case now, for me to get this denominator that I want to put here, so this is the formula I will use. The nominal value is 10 million naira multiplied by X int price. The price of the bond, so of the debenture, is 102 naira divided by 100 naira. Okay, so this will give me the market value of the debenture, which is going to be 10,200,000. Use your calculator. This should be 10,200,000, I think.
Yes.
Okay, 10,200,000. So that's the total value of the debenture. So I will then come here, 10,200,000. Of course, which should be multiplied by 100%. So this should be 900,000 divided by 10,200,000 multiplied by 100 over 1. So this will always give you the same amount as 9%. Okay, you can see all the stress we go through for us to be able to get the same answer. All right, that's what I said, that it's always better to use the power value. The power value is shorter. You don't want to be going through all of this. You are still doing this, your colleague has moved to the next question. All right, so you need to avoid that. So Victor, are you fine now? Victor, can you hear me? Hello?
We can hear you.
Why is everybody quiet? Victor, you are the one that raised question, that asked question. You are not even responding. In any case, so that's as per that. Let's move on to the next one. I want to stop sharing this. Okay, let's have one more example before we move to irredeemable. All right, so I need one of you to read illustration number 7. Okay, who is helping us? Illustration number 7. Moses, go ahead.
All right, sir.
What's your... Go ahead,
Jonato,
Moses.
all right. Jonato PLC has 11%. So let me take that again. Jonato PLC has 11% irredeemable debenture of 5 million naira in its capital structure, which currently yield 8%. Required. Determine the value of the company's debenture.
Thank you very much. So please mute. You want to determine the value. Examiner is asking you to calculate the value of the company's debenture. All right. So let me switch so that I can tell you what market value of the debenture is. Okay. Solution to illustration number 7. Okay. Illustration number 7. That's still on page 47 or 46. Page 46. Okay. The name of the company is Debenture. Debenture PLC. So examiner is asking us to determine the value of the company's share. Okay. Yes, Victor, go ahead.
Sorry, that was a mistake. Sorry.
So we want to determine the value of the company's share. So I would then say calculating the value, the value of the debenture. Calculating the value of debenture. Okay. Now, you need to know, before you begin to calculate, you must understand what's the market value of debenture or market value of debt. I actually keep this till when we get to work, but since examiner has asked you, let me just show you. Now, the market value of debt represents the present value of the future cash flows discounted at the yield or cost of debt. Now, when you talk about present value is the same thing as market value. So the future cash flow that the company we pay is the fixed interest if it is irredeemable debt. So the future cash flow that the company will pay is the fixed interest. But if it is redeemable debt, then the company will pay both the fixed interest as well as the principal at the maturity date. So when you talk about market value of debt, it represents the present value of future cash flows discounted at the yield, okay, discounted at the yield or cost of debt. So in this particular question, we are not given the redemption date. That means, in fact, it's even showing in the question that this is irredeemable debenture. Therefore, let's quickly solve this so that we'll move to the next one. I will then say let me just show you the market value. Let me write it out in full. The market value of irredeemable debenture is the present value of future cash flows let me rewrite that. Of future cash flows, that is interest expense, discounted at the yield. The yield is just like a return, discounted at the yield or cost of debt. Okay, so that is the meaning of market value of irredeemable debenture. So when you want to calculate the market value, according to the question, you have to calculate market value of the debenture, which will be calculated as the fixed interest. Okay, let me do it this way. The market value of irredeemable debt. Irredeemable debt or debenture okay, is calculated as the ratio of fixed interest to the yield or cost of debt. Okay, so that's how to calculate the market. Whenever you have to calculate market value of debt, so you pick the market value of the debenture is calculated as the fixed interest where there is no tax. Where there is tax, you include 1 minus tax. But in this particular question, we are not given tax rates. So divided by the cost of debt. Okay, this is just you saying that, for example, the cost of debt we have calculated here. Look at the formula for calculating cost of debt. This formula. So the denominator that you have here is the market value of the debt. Okay, this is the denominator is the market value of the debt. So examiner is now asking you to calculate that denominator, the market value of the debt. So all you need to do is just cross multiply. Okay, so whenever you are asked to calculate the market value of irredeemable debt, so it's simply the fixed interest divided by the cost of debt. Cost of debt is the same thing as KD. This is market value of the debt. So where there is tax, the market value of the debt will be equal to the fixed interest multiplied by 1 minus tax, then divided by the cost of debt. So you have to know all of this. All right, so let's move on. So in this case, I would then say, according to the question, what's the coupon rate given to us? What's the interest rate given in the question? You are told that Jonato PLC has 11% irredeemable debenture of 5 million naira. So the interest rate is 11%. All right. The yield is 8. The yield is the same thing as cost of debt, which is 8%. Therefore, 11 divided by 0.8 will give us the value of the debenture. So I would then say 11. There's no need for you to say 11%. Just say 11 divided by 0.8. The fixed interest, the coupon rate of this debenture is 11%. So 11% multiplied by 100 naira, because it's quoted at 100 naira per unit, it will give you 11. So just ignore the percentage. So put 11. The yield is the same thing as cost of debt. This is the same thing as yield. Okay? You can call it yield or you call it cost of debt. Then this is 8%, which is 0.08. So what do you have? 11 divided by 0.08. What do you have? Give it to me quickly.
I have 137.5.
137. You said 137.5 naira. So the value of this irredeemable debenture is 137 naira 50 kobo. So if I want to calculate total value of the debt, then this is what you are supposed to do. If I want to calculate total value, alternatively, I want to use absolute value. So I would then say market value of the debenture equal to the interest rate given to us is 11%. So I will say 11% multiplied by, what's the nominal value of the debt? The nominal value of the debt is 5 million naira. The nominal value means the same thing as book value or face value. All right. So the nominal value is 5 million naira. So I would then say 11% of 5 million. So divided by the cost of debt. Cost of debt is the same thing as the yield as given to us. So we are given a yield of 8%. So what's 11% of 5 million naira?
550,000.
Yes,
550,000. 550,000.
550,000.
550,000.
Yes.
Okay, so 550,000 divided by 0.08, 0.08. What do you have?
I have
6,000,000.
6,875,000.
6 million.
875,000.
Okay, 6,875,000.
Yes.
Okay, so this is the market value. This is the market value of the debt. Now, the first one, you can see here that if I now want to, of course, we have calculated the value of the debt. Let me rewrite this formula. So let me put the formula there. Let me put the formula so that it will be clearer. Let me write this. Let's do it this way. Now, according to the formula, this is supposed to be the fixed interest, okay, divided by the yield. We are given the yield in the question. So this will give us the market value of the debenture. So the interest, the fixed interest will be the coupon rate multiplied by the nominal value. The nominal value, the coupon rate is 11% multiplied by 5 million naira. Okay, so when you do this, your numerator will represent the interest. And the interest in this case is 550,000 that we got. The yield is already given to us as 8%, which is 0.08. So divided by 0.08. And finally, we got 6 million. It says 6,750,000, right?
No,
Six
sir.
million
That was
6,875,000.
850.
875.
Yes, 875.
Yeah.
875. So this is the amount. This is the market value of the debt, of the debentures. This is the total, sorry. This is the total market value of the debt. Now, when you say, if you want to, for the first one that we solved, this one that gave us 137.5. 137, let's say, for example, I want to confirm that 137, you recall that earlier I mentioned to you that the market value of debt is calculated as nominal value multiplied by X int price divided by 100 naira per unit. Okay, so if you want to confirm this, I want to use this one to confirm that. So in this case, the nominal value is 5 million naira, according to the question, multiplied by X int price. We have calculated 137.5 naira, then you divide it by 100. So what do you have? Is it the same thing as 6,875,000?
Yes,
Yes,
it
sir.
is.
So whether you use par, if you want to use par value to calculate your market value, this is what you are supposed to do. You do it this way. If you want to use absolute value, this is the formula, and this is how you are going to do it. On the day of your exam, don't go and be demonstrating the two. Just use one that is more convenient for you. At all time, always use the par value, except if examiner is specific. If examiner wants you to use absolute value, you may be told. But in most cases, it will be silent. So you're at liberty to use either par value or absolute value. Why do I want to be going through all of this stress when I can just use par value within few seconds, I get my answer. I move to the next one. All right. So that is basically that. Now, let's move to redeemable. But let me know if you have any question before we switch. Any question? Okay, then.
Yes, sir. Okay.
Yes, talk to me, Moses. Sorry,
no,
Femi.
it's Femi, yes, sir. This one, this X int price now. How do you know that it's X int price? This question illustration 7. How do you know that it's X int and it's not S cum? I mean cum
Is
int.
there in the question? I explained to you earlier that if the interest, I told you, note, if, look at, I've explained it earlier today. Let me show you so that you understand. This is
Okay,
my
sir.
notes that I gave you earlier today. When cum int price is given, it should be, oh, I wanted to put converted. It should be converted to, I missed something there. It should be converted to X int price before calculating cost of debt. And I said that if the fixed interest has not been paid, it means that the market price of the debt is cum int price. Okay? If the interest has not been paid, it means that the market price of the debt is cum int. So you don't use cum int to calculate cost of debt. It has to be X int price. So to now convert cum int price, let me finish. To now convert cum int price to X int price, then this is the formula you are supposed to use. Now, go ahead, Femi.
Okay, you said one of the way we can know if the interest has been paid or not been paid is if the interest has not been paid, they will now know it is X int, right?
Cool. If interest has not been paid, that is cum int. Examiner may not call it cum int, but so if in the question you are told that interest has not been paid, so examiner may not call it cum int, but once there's indication in the question that interest has not been paid or interest is still outstanding or interest will be paid, provided the interest is still outstanding, it means that the market price of the debt is cum int price.
Oh, okay.
Do you
And
get?
now this illustration 7, how do we know that the interest has not been paid, sir?
According to the question,
okay,
when
sir.
you look at the question, you are told that Jonato PLC has 11% irredeemable debenture of 5 million naira in its capital, which currently yield. So here, examiner is telling you that you can see you are not told whether interest has been paid, debenture interest has been paid or not. Where examiner is silent, you are going to assume that it has been paid.
Oh, that's what I want to do. Yeah, that's what I want.
So if examiner wants you to do something, they will tell you, there will be indication in the question, that will be clear in the question to direct you that, okay, interest has been paid or interest has not been paid. But where examiner is silent, you are not told whether, there's no indication of whether interest has been paid or not. So you are going to assume it has been paid. Are we together?
Now I get it now. Thank you, sir.
Oh, you're welcome. So let's go to redeemable debt. Let's talk about redeemable debt. All right. Okay. Costs of redeemable debt. Okay. First thing first, you must understand what is redeemable debt. Redeemable debt is the one in which the company is expected to pay annual fixed interest and the principal at the maturity date. Let me put it down for you. The redeemable debt is the one in which the company is expected to pay annual fixed interest and the principal and the principal at the maturity date. Maturity date is the same thing as redemption date. Okay, so when you talk about redeemable debts, every year the company will be paying annual fixed interest. So at the redemption date, that is the date when the debt will mature, that the company will redeem it. So at that date, the company will pay both the fixed interest as well as the principal sum. All right. So debt can be redeemed. Debt can be redeemed at par, premium, or at a discount. At a discount. Of course, like I mentioned last week, if debt is only quoted at 100 naira per unit, that 100 naira is the par value. So if it is more than 100 naira, that means the debt is quoted at a premium. If it is below 100 naira, it means that it is quoted at a discount. Okay, so like I said, the par value is equal to 100 naira. Where the question is silent, you are going to assume it is quoted at 100 naira per unit. Okay, but if it's at a premium, it will be greater than 100 naira per unit. If it's at a discount, that means the debt is quoted at a price less than 100 naira per unit. Okay, so that is basically that. Now, what do you then mean by cost of redeemable debt? So the cost of redeemable debt, the cost of redeemable debt, let me write it. What's wrong with you? Okay. The cost of redeemable debt is also known as internal rate of return. The cost of redeemable debt is also known as the yield to maturity, YTM, the yield to maturity or internal rate of return. Okay, it is calculated by assuming two discount rates that will produce two opposing NPV. It is calculated by assuming two discount rates that will produce two opposing NPV. Net present value, that is a positive net present value and a negative net present value. Okay, so you know that whenever you want to compute internal rate of return, you are expected to assume two discount rates. One discount rate will give you a positive NPV. So when you have a positive NPV, you increase the discount rate to get a negative NPV. Then you then interpolate into the IRR formula. Okay. So I said this is calculated by assuming two discount rate that will produce two opposing NPV. Okay. And then interpolate into the IRR formula. Okay, as given below. Okay, so whenever you want to calculate the cost of redeemable debt, which is denoted as KD or IRR, is calculated as A, that is lower discount rates, plus the net present value of the lower discount rates divided by the net present value of the lower discount rate plus net present value of the higher discount rate, all multiplied by higher discount rates minus lower discount rates. So this is the formula for calculating cost of redeemable debenture, cost of redeemable bond, or cost of redeemable debt. All right. So it's as simple. We did similar thing last week under cost of a redeemable preference share. So it's the same thing. All right. So this is how, whenever you are asked to calculate cost of redeemable debt, simply go ahead and calculate internal rate of return. Okay, just go ahead and calculate internal rate of return. It's as simple as that. So if that is the case, now one thing you need to know, I mentioned it earlier under the irredeemable debt, but let me put it down. Note, the cost of redeemable debts will be computed only if the redemption date is given. However, if the redemption date is not given, if the redemption date is not given, it will be computed as cost of irredeemable debt. Okay, as cost of irredeemable debt. So that's it. So you need this redemption date. It's very important when it comes to redeemable debt. The redemption dates or the maturity date must be given to you. All right. So that is basically that. Let's have illustration. I'll stop sharing this and move to the study material. Okay. So you go back to your material and read more. Let's have illustration number 9. Let's have illustration number 9. Now, okay, maybe let me see if there's any question that relates to market value of redeemable. Okay, yes, I'll come back to that. Let's have illustration number 9. Who is helping us to read, please? Moses has read. Ugechi also read. Let me look for, yes, Blessing Friday. Blessing. Are you there, Blessing? I want you to read for us. Blessing.
I'm here.
Okay,
Illustration
thank you.
9.
Yep.
Mary PLC has 10% redeemable debenture in its capital structure. The debenture is currently quoted at 106 naira x interest and it will be redeemed at par in 5 years' time. Required, calculate the cost of the company debenture.
Thank you very much. A Blessing. Yes, that is the question. That is the question. You are told in this question that Emery PLC has 10% redeemable debenture. It's very clear in the question that this is a redeemable debenture. It's written as redeemable debenture. And I told you that debt will only be redeemable if the redemption date is given to you. So in this question, you are told that it will be redeemed at par in 5 years' time. So in the next 5 years, this debenture will mature. So that means we can confirm that this is a redeemable debenture. So if this is a redeemable debenture, what else are you supposed to do? Just go ahead and calculate the internal rate of return. And the good thing about this is the examiner also told us in this question that the debenture interest currently quoted at 106 naira x int. That means the interest expense has been paid. So there is no need for you to make any adjustment. The 106 naira already exclude interest. So no need to make any adjustment. So if that is the case, let's solve this particular question. I will stop sharing and move to the working notes. Okay. Solution to illustration number 9. Page, I think that's page 47, 46, page 46. Okay. Igbayima, what have you done to my screen? Okay. So we want to calculate cost of redeemable debenture. The name of this company is Emery PLC. Emery PLC. Okay. So I would then say calculating costs of redeemable debenture. KD. All right. That's what the examiner wants us to do. So if that is the case, and I told you that whenever you want to calculate cost of redeemable debts, first thing first, you must confirm from the question that it is actually redeemable. How do you confirm it is redeemable? If the redemption date is given to you, then you are expected to calculate cost of redeemable debt. Then secondly, you need to check from the question if debenture interest has been paid. So if debenture interest has been paid, so it means that the market value given to you is already X int price. But if debenture interest has not been paid, it means that the market value is cum int price. Therefore, you need to convert the cum int price to X int price. But as far as this question is concerned, the market value of 106 naira given to us is already X int price. So no need for any adjustment. So without wasting more time, and I said that whenever you want to calculate cost of redeemable debt, there are two procedures you are supposed to carry out. The first procedure is to assume two discount rates that will produce two opposing NPV. That is, you use one discount rate to calculate NPV. If the discount rate produces a positive NPV, you increase it to get a negative NPV. Once you have a positive and a negative NPV, you proceed to calculating the internal rate of return. Internal rate of return is the same thing as yield to maturity, is the same thing as cost of redeemable debt. So that is what we want to do quickly within the next few minutes. Therefore, I will then come here, assume. I explained to you last week, whenever you are calculating redeemable debt or redeemable preference share, always start from 10%. Because if 10% give you a positive NPV, you can easily increase to 15%. If 10% give you a negative NPV, you can reduce to 5%. And when you are calculating cost of capital, the difference between the two discount rates that you are going to assume should not be more than 5%. If you assume 15%, if 15% give you a positive NPV, you increase by 5% to 20%. All right. So you cannot just increase from 15% to 30% simply because you are looking for negative NPV, because that is not attainable in the markets. You cannot, it's not possible for you to have 100% in the market. So you have to be realistic. So I would then say assume 10%. So again, we are going to use only one table instead of using two different tables. I'm showing you exam technique. So instead of using one table to calculate positive NPV, another one table to calculate negative NPV. Since the NPV you want to calculate have the same cash flow, why are you using different tables? So we are going to use only one table. Therefore, to calculate the NPV, so create column for year, description of items, we have cash flow. Let me give a space. We have cash flow, discount factor. All right. Then we have present value. Okay. So you are starting from year zero. In this year zero, this is where you have the current market value. This is where you have the current market value of the debenture. I will then go back to the question. What's the market value of the debenture? Examiner told us is 106 naira x int. Because the interest expense has already been paid, that's why it is called x int. So there's no need for me to make any adjustment again. But if this 106 naira is cum int price, I need to first of all go and deduct interest expense, then to have my x int price. So because already is x int price, so I don't need to do any adjustments. Then I will then go back to the question. I need to go and check the maturity dates. When are we going to redeem this debenture? Examiner told us that it will redeem in 5 years' time. So it means that the company will pay annual fixed interest. Year 1, year 2, year 3, year 4, year 5. The interest is fixed. So because the interest is constant, I will then come here, year 1 to 5. Fixed interest. How much is the interest? Let's go back to the question. What's the interest rate given to us? Talk to me. What's the interest rate?
10%.
10% is the interest rate. Okay. So I will then come here, I'll put 10. There's no need for you to say 0.10. Because 10%, I already told you that debt is always quoted at 100 naira per unit. When you say 10% interest, you are supposed to multiply with 100 naira, because debt is always quoted at 100 naira per unit, which will give you the same thing as 100. So it will give you the same thing as 10. So just forget the percentage, ignore the percentage, just put 10 there. Then finally, in year 5, this debenture will be redeemed. Okay, I will then come here, I'll put redemption value. I will then go back to the question, how am I going to redeem the debenture? Is it at par, at premium, or at a discount? According to the question, we are told that it will be redeemed at par. At par means at 100 naira. So I'll put 100. So you can see, examiner did not tell you that this 100 naira is not given to you in the question, but it is implied. When you look at, when I was explaining earlier, I mentioned, look at, when I was explaining earlier, this is what I told you. At par means 100 naira. At premium means it must be greater than 100 naira. At a discount means that it is less than 100 naira. So examiner will not tell you that 100 naira will not be given to you, but you should, it is expected that you know it. So it is implied in the question. Debt is always quoted at 100 naira per unit. So that is the par value you are seeing there, 100 naira. So I will then, of course, I need to determine the discount factor at 10%. So I will then come here at 10%. Let me roll this. Okay. Let me complete my table first. Okay, this is the NPV we want to calculate. All right, so discount factor at 10% for year 0 is 1. 1 multiplied by 106 will give us 106. $106. Okay. Now, somebody should give me annuity factor of year 1 to 5 at 10%. We did it last week. Yes, who is helping us? Quickly, quickly, quickly. Annuity factor year 1 to 5 at 10%. What do you have? Yes.
3.791.
Thank you. 3.791 is the annuity factor. If you don't know how we got it, ask question, I will show you. But for now, I assume that you know it. Please, you don't need to be shy.
Sir, please,
Although
how
you
did you
can
get?
see nobody. Okay. Now, okay. Okay. Blessing, yes. Talk to me.
Yeah, same question I wanted to ask.
Okay, then. So let me show you. For all of you in this class, this is going to be the last time I will show you how to calculate annuity factor. All right, so you better know it now. Next time, you are the one that will give me the number. So annuity factor is computed as 1 minus 1 plus r raised to power minus n, all divided by r. The r is the discount rate. N is the maturity date, or you can call it useful life. So since we are assuming 10%, so this then will be equal to, let me put it this way, let me write this, at 10%, a discount factor of 10%, so this annuity factor will then be equal to 1 minus 1 plus 10% will give us 1.1. The maturity date of this debenture is 5 years, so minus 5 divided by 0.10. So this will give you 3.791. Okay, that's how we got the 3.791. Blessing and is it Femi? Hope you understand now. Blessing.
Yes, sir. Thank you.
Blessing. Oh,
Yes,
okay
sir.
then.
Thank you.
You're welcome. So that's how we got that. Then you need to do discount factor at 10% for year 5. This will give you 0.621. Again, discount factor is calculated as 1 plus r raised to power minus n. So in this case, at 10%, discount factor for year 5, okay, this will be 1.10 raised to power minus 5. So this will give you 0.621. Okay, so that's that. Now, to now get the present value, you are supposed to multiply the cash flow with the discount factor. So 10 multiplied by 3.791. This will give us 37.91. Am I correct? Let's do round number.
Yes, it's
Round
correct.
figure. So round figure is 38. Then 100 multiplied by 0.621 will give us 62. Okay, so 38 plus 62, that's 100. 100 minus 106 will give us minus 6. So we assume 10% and we got a negative NPV of 6. So since 10% give us a negative NPV, we need to reduce the discount rate to get a positive NPV. Therefore, I would then assume 5%. So discount factor at year zero at 5% is 1. Then I need annuity factor of year 1 to 5 at 5%. What do you have there? The same way we calculated the 3.791. So instead of 10%, it will be 1 minus into brackets 1.05 raised to power minus 5 divided by 0.1. Give it to me. What do you have there?
4.329.
4.329. Then discount factor at 5% for year 5 would then be equal to 0.784, right? Is it?
Yes, sir.
0.7. Okay, then. So let's multiply. 4.329 multiplied by 10 will give us 43. Rounding. That will be 43.29. You round it to whole number. That's 43. 0.621 multiplied by 100. Sorry, 0.784 multiplied by 100 will give us 78. Then 1 multiplied by 106 will give us 106. 43 plus 78, that's 121. 121 minus 106, that should be 15. Am I correct? Are you guys with me?
You are correct.
Okay, Naomi. So if that is the case, I've calculated, we assume 5%, we got a positive NPV of 15. We assume 10%, we got a negative NPV of 6. So at this point, we need to calculate cost of redeemable debt. I would then say KD, or internal rate of return, is calculated as lower discount rates plus the NPV of the lower discount rates divided by the NPV of the lower discount rates plus NPV of higher discount rates, all multiplied by higher discount rates minus lower discount rates. Okay, so equal. We assume 5% and 10%. 5% is lower. A is the lower discount rate. So I will say 5 plus NPV of that 5% is 15 divided by 15 plus NPV of higher discount rate, which is 6. All of this multiplied by higher discount rate of 10 minus lower discount rate of 5. Final answer, what do you have? So 15 divided by 21 equal, multiplied by difference between 10 and 5 equal, then plus 5. What do you have there? What's your final answer? 15 divided by 21 equal, multiplied by 5 equal, plus 5 equal 8.57. This is 8.57%. Therefore, the cost of the redeemable debenture is approximately 9%. So this is how to calculate cost of redeemable debt. Yes, Ayodeji, talk to me. You raise hand.
Yes, sir. I don't understand how you get 10 minus 5, sir. The 10 minus 5. How you get 10 and also 5, sir?
Look at the formula. A represents lower discount rates. B represents higher discount rates. So higher discount rate minus lower discount rates. Look at in our calculation of NPV, we assume 10% discounts. We also assume 5% discounts. 10% is higher than 5, isn't it, Ayo?
Yes, sir.
So that's how we got the 10 and 5. B represents higher discount rates. A represents lower discount rates. B is 10%, A is 5%. I believe it's clear now.
Yes, sir.
Okay. Igbayima, talk to me. Igbayima, Andrew,
So can you hear me now?
I can hear you. Talk to me.
Yeah, the 6, the negative MPV. Why
Yes.
you use a positive value?
Pardon?
Why substituting you use a positive value?
Why
Why showing
substituting?
you use a positive value? Yes.
Are you saying from this formula?
That is the 15
Are you
plus.
referring to the formula? Hold on, hold on. Are you referring to the formula? Okay, you are referring to this.
Yeah, so you see 15 plus 6.
Yes.
I was thinking the
Were you were,
negative.
were you in my class last week,
No, sir.
Andrew? No.
No,
Okay.
no, sir.
That's what I will explain because I explained this last week also. Now, the original formula for internal rate of return is IRR is computed as the lower discount rate plus NPV of lower discount rate divided by NPV of the lower discount rate minus NPV of higher discount rates. Okay? All multiplied by higher discount rate minus lower discount rate. This is the original formula of internal rate of return. Usually, higher discount rate is always in negative. That's why you see at this 10% discount rate, NPV is -6. So negative times negative will give you positive. And that's why I always use positive here instead of negative. Because at the end of the day, by the time you multiply it to be negative times negative will give you positive. Do you get now? So if I want to do this now, what I would just say, what I would do is that, of course, here is 5 plus NPV of that 5 is 15 divided by 15 minus NPV of that higher discount rate is 6. So all of this multiplied by 10 minus 5. You can see from your denominator, 15 minus 6. Minus times minus return to positive, isn't it, Andrew?
It is, I understand now.
So this one will now be equal to 5 plus 15 divided by 21 because 5 minus 6 will give you positive. So that will be 5 plus 15 divided by 21 multiplied by 5. So you get your answer to be approximately 9%. Yes, somebody was raising hand the other time. Somebody is asking, can we use lower and higher instead of A and B? This it's just a letter. Whatever that is more convenient for you is what you should do. David, yes, you can use lower and higher, L and H, if that is what you are used to. So be it. You are going to get the same thing. All right. This is just my own. So it's not compulsory that you must use what I've used. If that is what is more convenient for you, go for it. All right. So let me clean this. It's not part of our solution. Okay. So that is, I would then say, to complete the question, I would then say the cost of redeemable debenture, the cost of redeemable debenture is approximately 9%. That's it. That's the end of the question. Okay. Wow. Time is fast spent. No. That we started. Okay. So let us see. Let's have one more illustration that has to do with market value of debenture. Now, let me know if you have any question before I switch. Any question for me? Although you've been asking your question though. Let's move on. Yes, Femi, talk to me.
Sorry, sir. Is this a annuity factor? I don't know. Is there because I was very impressed the way the lady quickly get that answer. Maybe she has been doing it before, but I don't know. My calculator, I have to press one, then I will write the figure down one minus r raised by. Is there
No,
any
no,
short
no, 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 no,
that
no,
we
no,
have
no,
to
no,
do?
no. That's not the way to do it.
Okay.
You have
So is there
you have
any
to apply
sharp?
mathematics now. You have to hold on, Femi. You have to apply board mass. You start from the parentheses. You cannot say one minus. You start from the parentheses. You start from the brackets. What is inside the bracket? So what is inside the bracket is 1.1. Therefore, from your calculator, you press 1.1 raised to power minus 5. You press answer. You keep it somewhere. Then you type 1 from your calculator minus the answer equal to divided by 0.1 equal to, you get 3.791. Do you get that, Femi? I take it again. From your calculator, you type 1.1 raised to power minus 5 equal to, then you press 1 minus answer equal to, divided by 0.1 equal to, you get 3.791. That's how to do it. Have you tried it, Femi?
Yeah, it's okay. I got it now.
Did you get?
Yeah, it's okay now. I understand now.
It's okay then. So let me stop sharing and let's have one more illustration before we close the day.
Please, sir, just show the working so that I can screenshot.
No, I will share immediately after the class. All right?
Okay.
Yes, Blessing, you wanted to ask question. Talk to me.
No, I was saying you should just show the workings so that I
Oh,
can
you are
screenshot.
the one. It's okay. No worry. I will share. No worry. Yes, somebody should read illustration number 7. Blessing has read. Ogechi has read. Then Moses also read. Let me look for somebody. One of you should read for me before I call name. Yes, this name, Adaugo. Hold on. Adaugo. I want you to read. Ada, Adaugo. Okay. Femi, you want to read it?
Okay, sir.
Sorry. My, I
Okay.
don't know. Hello, good evening.
Good evening. Go ahead. Illustration
Hello.
number 8. Yes, I can hear you, Ada. Go
What
ahead.
illustration will be 10?
Pardon? Ada, are you saying something? Okay. Femi, you may want to read. I can't hear Ada. Maybe she's talking. I
Hello, can
can't
you hear
hear
me
her.
now?
I can hear you. Yes. Go ahead.
Okay, so I was saying, is it illustration 10 to be sure?
No. Illustration number 8.
Oh, okay. All right. Illustration number 8. Hazard PLC is financed with 8% redeemable debenture with the total nominal value of 10 million. This debenture will be redeemed in 10 years' time at a premium of 5%. The current yield of the debenture is 7%. Required, calculate the unit value of the debenture.
Thank you very much, Ada. Yes.
Thank you.
You have to be very careful whenever you are given a question. And that's why I always advise students that you should start from the requirement of the question, because once you are given a question paper and you are asked to start, go straight to the requirement before you begin to read the body of the question. What's examiner asking me to do? You must understand the examiner's requirement before you begin to read the body of the question. You already know, you already have the idea of what the examiner is asking you to do. So when you are reading the body, you'll be able to identify the relevant variables that you are going to need. So in this particular question, examiner wants you to calculate unit value of the debenture. You want to calculate the market value of debenture. So how do you calculate market value of debenture? What kind of debenture is this one? Is this redeemable debenture or irredeemable debenture? You must identify from the question. Has the debenture interest been paid or is still outstanding? What is the coupon rate? What's the interest rate given to me in the question? All this information. Am I given tax? Am I given tax rate? You are the one that will be asking the question. And then you must be able to identify the relevant variables that you need to solve the question. So I want to calculate market value of debenture. So we have identified from this question that this is redeemable debenture. How is it a redeemable debenture? Because examiner has given us redemption date to be 10 years time. Then how are we going to redeem this debenture? We are told that it will be redeemed at a premium of 5%. So if that is the case, let's quickly solve it. Somebody is asking question. Annuity, oh, okay, you are given the annuity formula. Thank you. That's David. All right, so let me stop sharing this and quickly move to the working notes. So let's solve this question together. Solution to illustration number 8. Page 46. Is it 46? I think so. Yes, page 46. The name of the company is Azad PLC. So I will come here, Azad PLC. An examiner wants us to calculate the unit value of the debenture. I would then say calculating the unit value of the debenture. So you want to calculate market value of the debenture. First thing first, you must know. You must identify from the question what kind of debenture. Because the way you calculate market value of redeemable debenture is different from the way you calculate market value of irredeemable debenture. So I've already demonstrated how to calculate market value of irredeemable debenture. Let's talk about how to calculate market value of redeemable. So I would then say, let me just show you. You don't need to write it down on the day of your, although if you write it down, examiner will not penalize you. You are just demonstrating your skills. You are telling the examiner that you know what you are doing. But again, you are not going to be penalized if you don't write it down, as in defining what market value of debenture is all about. For your knowledge sake, that's what I'm writing it down so that when you are on your own, you'll be able to relate with what we are doing. That's what I'm trying to put it down for you. So the market value of redeemable debts. Okay, the market value of redeemable debt represents the present value of future cash flow, present value of expected future cash flows. Okay, expected future cash flows. That is, now pay attention here. What's the expected, as far as redeemable debt is concerned, the expected future cash flow are in two folds. One is the annual fixed interest, that is annual fixed interest plus the principal. Those are the two cash flows. Because a redeemable debt is the one the company will pay annual fixed interest and the principal at the maturity date. So when you are calculating the market value of redeemable debt, it represents the present value of the expected future cash flows discounted at the yield, or cost of debt. So this is how to calculate the market value. This is the meaning of market value of redeemable debt. So to now calculate the market value of redeemable debt, whenever you are asked to calculate the market value of redeemable debt, simply go ahead and calculate the present value by multiplying the cash flows with the discount factor or with the annuity factor. Add it together, you get your answer. Okay, let me just put it down for you. The market value of redeemable debt is calculated by multiplying the future cash flows, that is annual fixed interest and the redemption value, which is the principal, and the redemption value, okay, and the redemption value, okay, with the discount factor, with the annuity factor, with the annuity or discount factor. Okay, so that is how to calculate market value of debt. So in this case, to solve this question, I would then say just the same way you calculate NPV, whenever you want to calculate present value, the same way you calculate NPV is the same way you are going to calculate the present value. The only difference is just that when you are calculating the present value, you don't include year zero. You don't include year zero. So if that is the case, I would then say calculating present value. And this place accommodates. Let's manage it, or I should go to the next page. Let me go to the next page. I don't want to manage. So calculating present value. Remember what I said. Market value is the same thing as present value. So if that is the case, so just as if you want to calculate NPV. So you create a column for a year, description of items, cash flow, discount factor. I will then go back to the question. What's the yield? Am I given the yield? Okay, we are given the yield to be 7%. The current yield of the debenture is 7%. Okay, so here is 7%. Then I will have the present value. So you can see it's the same format that we use to calculate NPV. You know, when you are calculating NPV, here you put year zero. Here you put here is the current market value. Here is the fixed interest. Okay. Here is the redemption value. But because we are calculating present value, you don't include year zero. This year zero will not be there because once you put year zero, that means you want to calculate NPV. You know, NPV is different between the present value of cash inflow and the present value of cash outflow. So when you are calculating present value, you don't include year zero. You ignore year zero. So I need to go back to the question. I want to know, when are we going to redeem this preference share, this debenture? We are told that the debenture will be redeemed in 10 years' time. So which means that the company will pay annual fixed interest from year 1 to year 10. At the final year, at the maturity date, which is year 10, this debenture will be redeemed. Okay? The debenture will be redeemed. How are we going to redeem the debenture? Examiner told us that it will be redeemed at a premium of 5%. Please, you need to ask question, anything that is not clear to you. So let me complete my table. This is the present value, which is the same thing as market value. Right. So I will go back to the question. Interest. What's the fixed interest given to us in the question? What's the coupon rate? You are told that 8% redeemable debenture. That 8% is the interest rate of this debenture. That's the coupon rate. So I will then go there and put the 8. Here will be 8. So year 1, the company will pay 8%. Year 2, 8%. Year 3, up to year 10 is the same amount of 8%. And that's why instead of us to be doing it year 1, year 2, year 3, year 4, up to year 10, since the 8% is constant, that's why we have to do annuity factor. A wise student should have gone ahead to give me annuity factor of year 1 to 10 at 7%. What do you have? Annuity factor of year 1 to 10 at 7%. Yes. What do you have? What's the answer? Annuity factor of year 1 to 10 at 5% at 7%. Am I on my own?
No, no. I'm
Okay.
calculating.
You are calculating. Okay. So you will do 1 point. What do you say is the answer?
5.34.
5.34. 5.3. Make it 3 decimal place.
5.389.
389. Okay, let me confirm your answer. Now, for those of you that are struggling to get the annuity factor, let's do it together. Let me just write out the formula so that we'll be speaking on the same page. All right. So annuity factor is calculated as 1 minus 1 plus r raised to power minus n divided by r. Okay. 1 minus the r is the yield. The yield given to us is 7%. Therefore, 1.07 raised to power n is the maturity date, which is 10 years time, minus 10 divided by r. R is 0.07. Therefore, I will carry my calculator to say, starting from the parentheses, 1.07. Okay, 1.07 raised to power 10 minus equal, all right? That's 5.508. So equal minus 1 equal divided by 0.07 equal 7.024. So the person that gave me 5.329, you are wrong. This is supposed to be 7.024. Okay? Yes, you can do it again. It's supposed to be
I got 7, sir.
7.024. Exactly 7 or 7.024.
Actually, I approximated this place.
You don't do that.
I don't. Oh,
Okay, this is 7.024. Then the redemption
Sir, please,
value, I
that
need to
minus.
go minus what?
That 1 minus before. Where are we going to, like, how we punch the calculator? Where will the 1 minus come in
I
to
said you are
calculate the
starting from the
accumulative?
parentheses. Hold on. You are starting from the parentheses. Parentheses is the brackets. So you are starting from 1.07 raised to power minus 10 equal. You have equal on your calculator. Just press 1. Press 1 minus answer. Or you can just say it's the same thing. You can just say 1.07 raised to power 10 equal minus 1 equal divided by 0.1. You get your answer. Just remove the negative that is there. So that will give you your answer. Or if you don't want to do it that way, you can say 1.07 raised to power minus 10 equal 1 minus answer you have in your calculator equal divided by 0.07 equal, you get 7.024. So we need to get discount factor for year 10. This will be 1.07 raised to power minus 10. This will give us 0.50. Is it 508? Let me confirm. So this will be 1.07 raised to power 10 minus, that's 5.08, correct. Yes, Blessing, have you tried it? Blessing,
Yes, sir.
Blessing Sunday, have you tried it?
Yes, sir.
Did you
Blessing
get
Friday. Yes,
did,
sir.
did you get 7.024?
Yes, sir.
Femi, did you get 7.024? Okay, I think you said you got
yes,
it, but
sir.
you're approximated.
I approximate. Yeah,
Okay.
yeah. Mm.
Yeah. So Victor, go ahead.
Sorry, my question is, must the discount factor always be 3 decimal place?
Of
Is it
course.
necessary?
Yes, you have to. Otherwise, your figures can be materially be different from what you are expected to do. That's why it is called discount factor. You can do 2 decimal place, you can do 4 decimal place, you can do 3 decimal place. I love to use 3 decimal place. In some questions, you may have just 2 decimal place, but your discount factor must be in decimal. All right?
All right.
Oh, sorry.
Sir, please, this after this year 10, that description item, what is under the interest?
Redemption value. I
Thank you.
shorten it. It's redemption value. I shorten it to red value.
Thank you.
So, you're welcome. According to the question, we are told that the debenture will be redeemed at a premium of 5%. Pay attention, please. You will recall earlier when I was saying that usually debenture can be redeemed or debt can be redeemed at par, at a premium, or at a discount. At par means at 100 naira. At a premium means must be higher than 100 naira. At a discount means it will be lower than 100 naira. So in this question, examiner gave us a premium of 5%. That means 5% over 100 naira. So that will give us 105. So here I will put 105. That's the redemption value. I hope you understand. I repeat again. According to the question, you are told that this debenture will be redeemed at a premium of 5%. The par value is 100 naira. We are given a premium of 5% over 100 naira. So 5% over 100 will give us 105. That's the 105 you are having here. So at this point, we need to multiply. So I would then say 8 multiplied by 7.024. That will give us 56, rounding, 56.192. So you round it, that's 56. Then 105, I'm coming to you, Elozo. This is 105 multiplied by 0.508. That's a 53.34, rounding 53. When you add the two together, that's 109. So the market value of the debenture, the unit value of the debenture is 109 naira. Yes. Elozo, talk to me. Please, did I pronounce your name very well?
You did very well, sir.
Elozo.
Yes,
Okay,
you
then.
got it. Okay, so sorry, sir. I just want to ask, how do we have the 0.508 under the DF?
That's the discount factor. Discount factor, as you know, is calculated as 1 plus R raised to power minus N. Okay? R in this case is the yield of 7%. Therefore, 1.07 raised to power N is 10 years. So minus 10. So this will give us 0.508. That is 1.07 raised to power minus 10. You are going to get 0.508. Is it clear?
Yeah, thank you, sir. Thank you.
You are welcome. So that's end of the question. Let me know if you have additional questions that I can provide clarity. All right. So it's a pity we could not do cost of convertible security today. We spent so much time explaining, but that notwithstanding. So it's better for you to understand it. Like I mentioned in our last class or during when we had, I think it was last week, I told you that all these questions we are solving, this is not the likely question you are going to see on the day of your exam. The essence of the questions we are solving now is to explain the concepts, how you are going to treat it, even in a bigger question. Whether you are given 10 pages of a question and you are asked to calculate all these things that we are doing, it's the same thing. But you cannot see this kind of a question on the day of your exam. This is just to explain the concept. Yes, Ogechi, talk to me.
Okay, so I just wanted to ask, following the question that says we should calculate the unit value of the debenture with this table and this
Yep.
109, that means we are done with this particular question.
Yes, that's the value. So you can, in this case, the next thing you need to do now, you need to explain, you just tell your examiner that the unit value of the debenture is 109 naira. That's it. You are done. That's the end of the question. Is it clear, Ogechi?
Yes, it is. Thank you, sir.
Or you are welcome. So any other questions so that we can close the class? In our next class, by the grace of God, we are going to do cost of convertible security. Then after that, I will introduce you to weighted average cost of capital. So give and take, we have about 3 more periods. Wow. We have 3 more periods to end the topic. Yes, Lesson, talk to me.
Sir, please, this
Lesson,
one,
yeah.
can you hear me, sir? This 105 that is under this cash flow. How do we arrive at it?
Yes. I said this 105, ordinarily, when you talk about redemption value, you need to go, before you put this figure, you need to go to the question, how are you going to redeem the debenture? Are you redeeming it at par, at premium, or at a discount? In the question, examiner told you that the debenture will be redeemed at a premium of 5%. So par value is 100 naira. Premium of 5% over 100 naira will give you 105. So that's how we arrive at the 105. Do you get it now? Blessing. Blessing?
Yes, sir. Thank you. I
Okay.
got it. Yes, sir.
You're welcome. Yes, any other question so that we can close the class for today? Okay. So in the absence of no further question, I want to say thank you to every one of you for joining the class. Again, you have the material with you. Please go ahead and read cost of convertible securities. Also read weighted average cost of capital. In our next class, those are the two items that we are going to be discussing. All right. So once we get to weighted average cost of capital, you are going to have a bigger question that we are going to solve. So after this, between now, if latest tomorrow or Monday, I will develop some questions based on what we have done, which you are going to solve for me, and you will share. I will tell you the deadline when you are expected to submit it. All right. So, guys, I want to say bye-bye to every one of you. I will see you next time by the grace of God.
Good
sir.
night.
All right. Good night. Thank you.
Thank you very much,
Good
sir.
night.
Thank you, sir.
You're welcome.
Thank you.
You're welcome. Okay.
Please, if someone can help share the previous materials that were shown now, that would be
No
nice.
worry, I will share immediately after this class.
Thank you, sir.
You're welcome.